you everyone for joining. Happy New Year. We have a great session for you today about investment banking, a topic I'm not super familiar with myself, so I'm excited to learn. My name is Shane Pinnock. I run the events over at 10 Capital Network. And today we have Shawn and Evan joining us, and we're going to get to that in just a minute. But during the session, if you have any questions, just pop them in the chat box and I'll be fielding them as we go. So yeah, don't be scared to ask questions. So let's just get right into it. Shawn and Evan, why don't you guys just tell us more about yourself and your firms? Shawn, you go ahead and start.
Shane, thank you for organizing this. My name is Shawn Flynn with Global Capital Markets. We're a mid-market focused investment bank headquartered in Irvine, California, but we have 6 offices around the world, including Shanghai, Hong Kong, Toronto. I'm on the Silicon Valley team here, 15 bankers total. We are sector agnostic, so generalists. We put the team together based on the deal. What we consider mid-market are deals, companies with revenue between 10 and 300 million, EBITDA 3 and 25 million. If it's a SaaS company, I mean, multiples now are so crazy, we'll look at things smaller, but what we mostly do, mergers, acquisitions, growth capital, secondaries. If you're not familiar with those terms, think of it this way. You're going through life, you meet someone special, you get married, that's a merger. Maybe as your family, you see that puppy on the street, you want to take it into your house, an acquisition. Your family now even bigger. The puppy grows, you need to take it to the vet, feed it some food, you borrow money, growth capital, puppy gets larger, big dog has its own puppies, maybe you want to sell off one of these puppies, and then maybe it's a dog goes public, or before that there's some shares that you want to sell secondary. So we work with those transactions throughout the life cycle of companies. That's our focus.
Great. Evan?
Great. Well, thank you, Shawn. Thank you, Shane. Evan Schwartzfarb, founder of Segment Capital. It's nice to meet everybody here virtually. I started Segment Capital 5 years ago after experience both as investment banker working in private equity and previous ran the day-to-day business at Barclays, working with all of our family office and business clients with businesses valued at less than 500 million. So started Segment 5 years ago, in some sense to continue some of that work, and that is to work with private companies, founders, companies in the lower middle market. Shawn sort of defined it well, although we work with companies from a couple of million of revenue up to call it 500 million of revenue, helping them through the investment banking process as consultants. We do that in a number of different ways, from pre-transaction planning to thinking about which and what firms are appropriate, helping people select firms, helping them interview, differentiate, hire, and then work and provide support through the investment banking process, all in a goal to help our clients get the outcome, the transaction outcome they seek. Happy to provide a little bit more. I think maybe we just jump into questions, but obviously, surely.
Yeah, no, of course. Thank you so much. And let's just start out really simple here. Evan, do you want to tell us what an investment banker does for a startup, for people like me who might just not know a lot about it?
By all means. You can see that we have not rehearsed who's taking which questions, so happy to do so. Shawn is a line investment banker, so he may be best, and I'll let him comment shortly after. But I think the way to think about it, generally speaking, from my perspective, again, I'm an investment banking consultant. I work with companies to help them through that investment banking process, and sort of part of that marketing pitch. Over the last number of years, I've helped over 150 companies hire, work with, and manage the process of an investment banking transaction. So from my perspective, an investment bank is an agent that works with a company to provide connectivity to the financial markets. That agent does a number of different tasks. Most notably acts as eyes and ears, understands the metrics, valuations, structures that are relevant in the marketplace, and provides guidance to a company related to those structures around a transaction, whether it's a capital raise or whether it's a sale transaction, a restructure, whatever the transaction might be. I think for this purpose of this conversation and the lion's share of the work that most likely that we're doing and that we're going to talk about here is really capital raises and sales.
Right.
That would be the short definition. I'll turn it over and let Shawn comment.
Yeah, so for startups, I mean, it really depends on the stage that startup is at, whether it's seed, A, B, D round. When it's seed, there's really not much that an investment banker can do except for give them some guidance, some advice. Hey, when you hit these numbers, these metrics, these milestones, then that opens up opportunity with institutional investors. These are kind of your different paths of fundraising that you could seek. These are some of your opportunities for funding. But when they're very young, very early, pre-seed, seed, other than that advisor, that outside person giving some suggestions, there's not too much. And I mean, actually, that's actually a lot right there, giving them advice, giving them suggestions. And the reason for it is to engage an investment banker. There's certain fees, and I'm sure we'll talk about this later. And if you're trying to raise $500,000, the investment banker's salary would be all of that and more. There are investment bankers that will work with companies that are raising, growth round of maybe 3 million at the very low end. Most like to come in around that $10 million range or more. And that also goes with how much they'll help you, what their resources they're going to put into it. But think, going back to what Evan was saying, the raising growth capital, they can help startups with that. Maybe the company, it's time for them to exit. They want to get acquired. They can run the process, find, strategic buyers, institutional buyers for the company. Maybe they're interested in merging with another company. Maybe they're interested in raising capital to acquire another. There's many types of transactions that startups will go through. I mean, some of these companies here, Silicon Valley, around the world, 1-2 years are already valued at $100 million. There's quite a bit. So, I mean, it really kind of depends on that stage of that startup, how valuable all the different resources that investment banker, all the different options that they can help and work with those companies.
Great, thanks. So on that note too, what exactly does an investment banker bring to the fundraiser M&A transaction? Just a little bit more in depth, yeah.
Oh God. Evan, can I start with this one?
Please.
All right. So one, experience. I think that's a huge thing. If it's your first time raising capital, if it's the first time selling your company, if it's the first time, you're going to be on the other side of the table of people who do this for their living. That experience, that's huge. Also, that barrier, that boundary where there's a middle person on your behalf that's taken kind of either the verbal or emotional abuse for you. That's a huge value that a lot of people don't see. Especially, if the company's going to get acquired, you're probably going to be working with those people on the other side of the table moving forward for years to come. And if there was some hostility in that transaction, it's better that the investment banker takes it because they're out of the picture at the end of the day, where, the entrepreneurs are still involved. But, in that fundraising M&A transaction process, you have someone on your team that's experienced, that's done this before, that can run the whole process from the very beginning to the very end. So you're not learning as you're going, you're learning, or you're leveraging the experience, the knowledge and resources of this group that you're working with. And everyone's incentivized the same way to, leave nothing on the table, get a win-win for everyone, make everyone happy. So there's that alignment throughout the whole process. And, I mean, we could talk about the steps later, but I mean, Evan, what would you like to add?
I think that's exactly right, experience. And I would put experience and put a slash next to that, also called efficiency, right? Which is, you're running a business, you are, especially in early stage companies, right? You're wearing multiple hats. And so how many additional hats can you take on? And so from a time perspective and efficiency perspective, right, you're outsourcing some of that functionality, right, to the investment bank to help you. The investment bank has market connectivity that you don't have, right? They are transacting regularly. And so working with an investment bank allows you to access that investor base potentially faster, just because the investment bank has worked with these investors or talked to these investors, over the years around multiple situations. And then, as Shane talked about some of the, the process, right? Getting into a process, and from the pushing and the pulling and the diligence and taking, whether it's verbal abuse or the negotiation, right, around a transaction, thinking around valuation, where is valuation in those negotiations? What I tell my clients is that the value of an agent is really important, because if you're dealing with an investor and you're being as honest and transparent going through diligence, and you're providing as much information about your business and answering all the questions, the investor starts to get to know you. And if you think that you're going to go through a diligence process and provide all the questions and go through and provide all your views around the business, and then you think you're going to bluff the investor, they don't know you, you're going to sit down now and play cards and negotiate around the value of the business, you've lost. Because the investor, right, is working with you, you're building a relationship and a trust factor, and now you're coming down to, where you're diametrically opposed on valuation, right? And maybe diametrically opposed is a little too strong, but you're at the point where you have to carve the turkey. And at that point, having somebody else who represents you to do it, I think results in a better outcome, or at least provides some ability to separate the personal and allows the entrepreneur, the founder, the management team some ability to step back and retain the goodwill and credibility that built throughout the transaction, and not have to put that on the line when you're going through a valuation or a term discussion related to, a transaction.
And I would also like to add that, when you work with an investment banker, or an investment banker represents you in any of these transactions, I've seen it before where companies have gone to institutionals and they've actually rejected them. But then when we present them, the doors are open with the idea of, hey, wait a second, we said no because, for whatever reason. But if an investment banker brings this deal to us, we know that it's already been pre-vetted. We already know that they're confident in it because they understand how we get paid off success. We get paid, and they're thinking they wouldn't have even taken this client on unless they were confident that there was something more there. So it opens up a lot of doors, I would say, as well. Not only, the relationships the bankers have built, but to complete new ones as well, just because there's that, that kind of prestige, that kind of thought of, okay, there has to be something here for everyone to be using their time on it.
Gotcha. Okay, so next, and I think this is a good question, and it might be more based off of the specific company, but at what point in the fundraise should a founder come to seek an investment banker and engage with one?
I mean, for me, earlier the better. Honestly, I really like it when companies start a conversation a year or 2 years before they actually want to do any type of transaction. The earlier the better, because there's still time to improve the business. There's still time to get the process, or there's still time to package everything so that when it is time to actually go out, everything's looking good, everything's aligned. So for me, earlier the better to have that conversation. The actual engagement, I mean, processes take time. A lot of people think it can be done, September comes around, oh, I want to get this done before the year's end. Or like, you're looking 6 to 9 months for most things, from the time the engagement's signed, to creating the data room, creating the market materials, to going out, to the end of due diligence, to, from begin to end, 6 to 9 months. So, before that, you want to start screening investment bankers who you even want to work with, because you're in a long process with them. And that screening, you may want to interview 5, 6 investment bankers before you pick the one. You may want to work with someone like Evan, who's got this network and he can point you in the right directions of which investment bankers would be a good fit for you. But you want to have those conversations way before it's time to even start the process for any of these transactions, or at least that's my thoughts.
I'd echo. Obviously, I'm in a slightly different seat. So I like to work with clients, as long as we can before. But we work all the time with clients that say, like, we're ready, right? We want to hire somebody this month, and we do that as well. I think that the point that Shane really mentions, Shawn, apologies, is that the idea is, you build a relationship over time. And that, the trust factor is very important. So whether you're using a consultant like myself to help you, connect with investment banks, or you're building a relationship in investment bank, months in advance of need, a relationship is really important, because it's you're going to rely 100%, right, on the value, the trust of that relationship. And the longer that the time you spend together, the more you understand each other's thinking, you understand shared values? Do you have the right ethos? And I think about it in some sense like, you don't pick a different accounting firm every year, right? You don't pick a different lawyer every year, right? The same thing is like an investment bank, right? You're looking to build that relationship. I have lots of investment banking relationships. I helped, again, dozens and dozens and dozens of companies work with an investment bank. And so whether it's, with myself, whether it's direct, I think you want to have, because the longer the relationship is, the more you can immediately have that trust. And, I think an accountant said this to me many years ago, which is everybody drives at a certain speed limit, right? Which is some people like to drive at 45, some people drive like at 55 and 65. And, the idea is you want to work and you want to drive with someone who's driving at the same speed as you. And so, regardless of skill, regardless of connectivity, the most important thing, right, is that you have a shared vision, I think, with your investment bank. And as such, the ability to learn that just takes some time.
Great. I just want to remind everybody in the audience before continuing that you can ask questions in the chat box. So I will be fielding those as we go. But for the next question, and this is a little similar, but how does somebody make the most of that engagement with an investment banker? Either can start. Sorry.
I'm happy to start because I work with lots of clients. We'll work on over a dozen transactions a year in a bunch of different industries, helping clients, not just work and select an investment bank, not just hire an investment bank, but also work through the process to make sure the outcome really works. And so we've seen a lot of best practices on things that work really well, and we've seen things that don't work as well. The two things that I would highlight today, and this is it's a much longer discussion, right? I mean, the goal of hiring an investment bank, the goal of doing a transaction is the outcome, but it's not just getting an outcome, it's getting an outcome that you're really happy with, right? As a founder, as an entrepreneur, as a management team. And so the two things I would start with that I think are absolutely most essential, and I'm sure that Shawn will echo many of these themes, is one, transparency. Not providing full information to the investment bank, not giving full sort of background to previous capital raises or previous inquiries or people that you've talked to around a capital raise serves no value, because it's all going to eventually come out, right? In terms of your past discussions, and the investment bank is going to want to do the best job they can, and they're going to want all the information related to things you've done previously. The same thing's true related to diligence and other matters about your business. Everybody has some fault, some wart, whatever it may be, right? I mean, no one has the perfect body and, forever and ever, right? It just doesn't exist, right? Tom Brady's great, but I'm sure, Tom Brady's got some faults there somewhere too. And so the idea would be to make sure you are, again, transparent and honest. That I think is number one in order to have a successful outcome. If not, then the only thing that you're doing is wasting time and resources, and eventually, like, you'll get over these molehills or mountains depending on the issues. But it's easier if you start level set and you're completely transparent from the beginning. The second is responsiveness. Deals have a life of their own, and the idea of getting a deal done should be about efficiency and trying to move in a coordinated, well-mannered, structured process to get to a conclusion. And when one side is not responsive, that creates issues in the process, and that's where things start to delay and stall, and it starts to get into what I found, right, the idea of deal fatigue, right, which is this is taking too long, or why is it so burdensome, or why is this happening, or why is that happening? Figuring out the cadence, figuring out how to work in the right manner, what the turnaround time should be, both the company side and the investment banking side, and getting into that rhythm, finding that cadence and being responsive, giving reasonable deadlines. If someone has information requests saying we will get this done by Friday, we will get this done in 1 week's time, and sticking to those timeframes just engenders an environment that creates a process that moves along orderly, that gets to the finish line. When these two things break, transparency and the responsiveness, cadence, that's the things where I see that transactions generally stall, frustration crouches in, other things start to manifest itself, which can take a transaction not off, but delay, extra cost, creates a dynamic, right, which may somehow affect, right, people's thinking or how they're going to negotiate, whatever it may be. So those are my top two tips, and certainly happy to add more, but don't want to monopolize the floor.
I think Evan was spot on, just for the record. The moment he was talking about the transparency at the very beginning, spot on with be open about the skeletons in the closet. Be open with who you've talked to in the past for either raising capital or maybe an acquisition offer, or that tell how those conversations, all that information, it's going to come out eventually. If it's done early, things can be moved along so much faster. The data room, I mean, off at the very beginning, it's going to take time. So allocate time at the beginning to get things in order, respond to emails quickly. I mean, it is a back and forth communication, and the quicker you're able to communicate and the more open and honest with the investment banker, and even at some level of what's going on in your life. I mean, there's been, deals where maybe the significant other is upset that it's taken too long, talking about, deal fatigue. It's not only the people that are immediately, and it's also family members, friends that, their emotions play a part in what's going on, and have that, that conversation and lay, all your cards on the table. It's because going back 6 to 9 months, maybe 12 months. I mean, depending on the deal, there's a lot of emotions that go on through different parts of from, yes, it's time, we're gonna do this, to, okay, now we're going out to the market, what's the feedback, to, okay, LOIs come in, who are we paying? There's a lot of, it's an emotional roller coaster for everyone involved. And going back to, the lanes, you're in it with that person, and make sure that you're comfortable talking, you have that rapport, you have that relationship with them. It's so personal. I mean, there's a lot of emotions that go on during this time that I don't think people realize going into the process.
Great. Well, thanks. Our next question comes from our audience, and it is, can you discuss typical fees for a $10 million raise? And if you were the entrepreneur, what key factors would you look at in choosing an investment banker?
Evan, should I take this, or? So
Please.
Okay, so fee structure, that ranges quite a bit. And what I mean by that is some investment banks, they like that ladder approach, where the first, this many million is this percentage, and this many is this, and then this, it gets less and less, or the reverse of it. Some banks say, okay, we will take some equity, some cash of the success. It varies completely. But there's also let me backtrack a little bit. So for that process, think of it this way: the investment bank might charge an engagement fee, a retainer fee, and a success fee. Everything more or less is negotiable. Sometimes the engagement's a little more, sometimes it's just written off completely. The retainer, sometimes a little bit more and the success is a little less, or the retainer is a little less and the success is a little bit more. Sometimes, that success fee is a percentage of what's raised, cash. Sometimes they want, cash and equity. It's different all across the board, whichever investment bank you talk to. So I don't think there's, I can't say for $10 million raise, it's this amount of retainer and this is success. That's it. It's going to vary quite a bit from bank to bank. Evan, from your experience.
Sure. I mean, again, we're slightly opposed on this question, so I'm going to preface that by that, which is, I work with my clients. I've negotiated and helped 150 plus companies, and so I'm out there to make sure my client gets the best deal possible, and certainly to align fees. So I think the first thing is that Shane sort of correctly described the components, right, from upfront fees, retainer fees, whether that's a one-time or monthly, to a success fee, whether it's some sort of ladder, a percentage that changes with various breakpoints, hurdles, whatever it may be. I mean, this fees we could spend the entire session talking about fees. So there's a couple, I think, of rule of thumbs, right? Generally based upon size. And a lot of investment banks have minimum fees. So, they have a minimum fee, and then, so you're going to have to pay the minimum fee. Where I know there's a very specific ask here. It's a $10 million, raise, and what should the fees be?
Well, a lot of that's with the deal itself. Like, how hairy is this deal?
Right. But so I don't want exactly. So it's hard. I don't want to give you a range and be off without knowing a little bit more. But there are some rules of thumb that I go through with my clients. I think generally speaking, investment banking fees are not very transparent, right? It's not as if when you buy legal services or accounting services that it's $1 per hour or it's a fixed fee for X. You just don't see that with investment banking fees, so they're not as transparent. When we negotiate with our clients, right, we try to find, we want our clients to get the investment bank they want, and we wanted to get it at the fee structure that they want. And we work with the investment bank. Again, we have some ideas of how to align the breakpoints, thinking about previous transactions to try to get to a fee structure that works, right? I mean, ultimately, at the margin, the transaction is either going to be super helpful for the business or not. And, slight movement on the fee shouldn't really affect it. But what I say to my clients all the time is we still want the benefit of the doubt our way, right? We're happy to pay for runaway success. And, if it's just, okay success, we want it to break our way. The second part of that is like what factors, and again, I'm happy to spend a lot more time talking about fees, and maybe that's something we bring to the end, because I don't want to, monopolize the conversation or make sure it's relevant to all people on the phone here. The factors. Selecting an investment bank, right? There's a lot of things to think about. A rule of thumb, just general guidance is, and it's nothing that's rocket science here. It's comparables, right? And so most people think about it like if you're looking and you're saying, okay, I'm looking to hire an investment bank, I'm looking to do a $10 million capital raise, and I'm a technology company. How many $10 million capital raises has that investment bank done, and something in your industry broadly defined? And let's say it's installing glass windows in commercial buildings. So like broadly speaking, construction services. How many transactions has the investment bank done that is either a capital raise or sale, very specific to the type of transaction that you're looking to do? That's a way to get just to funnel down without having to go through all the various factors from connectivity to what the fees might be, just to understand the previous experience and if there's existing transactions that are similar. And the reason that is because if the investment bank has gone through it a few times before, they already have ideas on how to get it done, and the chances of success are going to be that much higher.
Great. Shawn, did you want to add anything there?
I think that was spot on. I mean, a lot of investment banks, they have their niche. We're best at this. This is what we focus on. And then going to interviewing them, getting to know them, getting to see if you work well with them, personality, and then moving forward. But yeah, everyone's got their, the lanes they play in.
Great. Well, moving a little bit back into fees, we have another question from the audience, tagging on to the previous question: how much equity in a percent or a cash percent of the raise amount would an IB charge? And what factors are considered in accessing those levels?
I'm happy to start.
Yeah, go for it, Evan.
Listen, when I negotiate for my clients, I mean, one of the selling points of hiring me is that, I think I can negotiate a better deal on behalf of companies, right? That's we certainly, that's not exactly how we sell our services, but no question. And when we look back over our client base, we think we've saved our clients, 50 to 150 basis points or more when it comes to the fee negotiation to what the client can negotiate directly. Our view is that, the asks tend to be big. The earlier the company is, right, the less mature it is, the asks are bigger. And so, if you're finding yourself in the 7% cash fee and the 7% equity, I would say that feels very rich, right? And the options warrants are things that people throw in that I think you want to be a little bit careful about. You want to think about the cash fee. If the bank isn't willing to take a cash fee and they have to have the equity in the deal, then I always try to throw it back the opposite way. Will you work for 100% equity, right? Will you just work for the warrants in the business? And generally people say no, right? They want the cash fee. So, the earlier it is, the bigger the ask and the more you sort of generally have to give up. If you are approaching double-digit numbers, I would say anything above double-digit feels very rich to me, especially in this environment, especially over the past couple of years, right? I mean, I've heard 7 and 7, I've heard 8 and 8. I mean, when I say these things, 8% cash, 8% warrants. Again, if it's 10% or more on a combined basis, I think that's very, very high. That feels very rich to me personally. Again, don't know the situation. I'm speaking broadly defined on my experience. And Shawn can, and I don't want to, again, say things that are going to be different than his experience. I'd like to think that we're aligned here. The investment bank's job can be very hard, right? We don't know the nature of the transaction. And so the investment bank will make a determination and decide how hard it will be. If you're finding these fees that are what I would call jaw-dropping, or that you are very uncomfortable because it sounds very rich, I would say it's because, either the transaction really is truly that hard, or the investment bank's just not that comfortable that they're going to get it done. And so because of that, they're asking for a very big fee. I think you want to find, an agent that's very comfortable in getting the deal done, knowing all of the parameters, and that's where you're going to find a fee structure that really works.
And I would say, take the time and ask the investment bank how they came up with that fee structure. I mean, they'll in most cases, I mean, they may not say everything, but they'll say, listen, we think this deal is difficult for these reasons, or we think we're going to be able to execute for these reasons. Where I see a lot more conversation is more that retainer, that fee, where depend on the situation, it's, hey, that's a lot of money for us at this time to get this raise or to get acquired, to run this process. How can we lower the retainer to increase the success? Or like, kind of that is where I seem to have more of the conversations versus just that success, that, equity cash, how that looks. Because most people, they go, okay, fine, I have to give more, but that happens. But that retainer, maybe, how long is it going to take? Is it 6 months of retainer? Is it 9 months of retainer? Where's the cap? Where's the limit? How much of that would go to the success? Those are the conversations. And I mean, going back to Evan, you could talk about fees for this whole thing and different negotiations. That is a beast of its own.
Right.
I don't, sorry, one more comment on that, which is, like any contract, and again, I don't want to impugn the investment banking profession. And so, like any contract, the first draft is probably not where you should be settling. Like the first draft of any contract, right? There's no perfect contract that comes to you over the transom, right? Every contract's going to need some sort of massaging in one way or another. And so along as you're thinking about fees and other terms, I think it's just one where, the idea of accepting something as given, right, is probably, if you're doing that, you're probably missing something, right? Whether it's fees or other terms in the engagement letter.
Great. So next question comes from the audience as well. Are you at liberty to discuss some of the key deals, that you may have worked on over the last 2 years, both domestically and internationally? Shawn, you want to start?
I mean, I can't say any names or things like that. I mean, we have worked on, network security deals. We've worked on blockchain deals. We've worked on, some ag tests. We've worked on, janitorial service deal. We've worked on quite a few. I mean, the bank I'm at, we got, 15 bankers, 6 offices. We've done deals everywhere. We've done quite a few. It's been the market in general for mergers, acquisitions for investment bankers over the last 2 years has been, or not 2 years, the last year has just been kind of pretty exciting. Most of the stuff I work on the Silicon Valley team is in the tech realm. But to actually say any like specific names, kind of not at liberty. So, but yeah.
I'd probably refrain from names right at this point. I'm sure if you look at our site, right, you'll see, list of transactions that I've worked on. I'm sure it's the same for Shawn. This past year, in the past 12 months, things that are outside of tech, and I work across all industries, so I'll do sort of tech last. Worked with a, call it a $10 million revenue plus bakery. Worked with a glass installation business. Worked with a jewelry business. Actually, all 3 of these businesses are family businesses that have been around for 20 plus years. Worked with an ambulance business. On the tech side, have done a couple of different technology deals in the past 12 months, $10 million ARR health tech business, a $10 million raise for a software SaaS business, a $5 million raise for a software SaaS business. I'm sure I'm missing a few here. A $30 million cap raise for for more of a health tech services business. So that's a little bit of the flavor. If there's something more, an industry in particular, happy to talk about things I've done in a very specific industry. I'm sure Shawn would be willing, or we can answer that too.
Shane, if you're okay with it, I could put like a PDF of the tombstones we've been in, or a link to our tombstone tab and on our website. For people
go for it. If you want to just drop it in the chat, whatever you want to do there works for me. Moving forward, Evan wants to know, different Evan from our audience wants to know best practices in general with deals, and just in other than transparency, alignment, and responsiveness, what are some things, 1 to 3 things made a deal successful, and also things that made it challenging for the investment banker?
Just writing some things down here. Give me 1 second.
Yeah, no problem. That was a lot to take in. It's also in the chat if you want to just read it there. It's from Evan.
Well, I'll start on that, which is, beyond transparency and beyond responsiveness, what makes a deal really work. There's a lot of factors, and I'm just sort of scribbling a few here. I guess sort of in no particular order, you got to know your numbers. If you are constantly, constantly referring to others or the team, and there's nobody that really owns the numbers, that makes things very hard, whether it's a CFO, a controller, an outsourced CFO. Someone has to own the numbers and stick to them. There can't be a debate around the numbers all the time. There can be, discussions about upside or downside, but somebody has to own it. And if you're the founder, you're the CEO, you're the senior member of the management team, you got to believe in those numbers, and you also have to have those numbers at your ready, because investors are going to talk around it. And if you're constantly referring to sheets and saying, oh, how did this get here, or I didn't do this number, or I'm not sure how, or it just wrecks the credibility of a process, really, really fast. So I would say, again, no particular order, but you got to know your numbers, you got to own your numbers, and you got to feel confident in your numbers. Another aspect that you sort of see in a transaction relates to your own contracts. Like, you got to really understand your contracts, because especially in tech, and people want to understand the quality of earnings, right? The quality of earnings now has become sort of a really, especially in sales, has become almost de rigueur, whereas 10 years ago the quality of earnings was done at sort of towards the end of the transaction. Nowadays, investment banks, things are moving faster, processes are condensing, and so the use of a quality of earnings report from an accounting firm outside to provide verification of numbers, and again, report on the quality, if you will, of the earnings, is become, again, the standard. And so as you have to engage or go through the quality of earnings report, and you think sort of through that, you got to know your contracts, because you don't want to be on the phone with an accounting firm, with an investor, and they're getting to something around how it recurs, the stickiness, whether it's again, metrics around CAC, whether it's around your market share, whatever it may be, and your own discussion of it doesn't actually align with what's in your contracts or what's in your financial model. That just doesn't work too. So again, maybe part of the first one to know your numbers, but it really is understanding your own contracts. And if you're not involved with writing your contracts, and the sales department's writing the contracts, that if you're beginning a process, you should take a look at your own contract to make sure you actually understand how a client engages, what they pay, whether it's professional services fees, whether it's the recurring side. That's again, super important in terms of making a transaction go. So just it's about knowing your business. If you don't know all of your I'm just pick something out, your OSHA requirements, or the notification that you need, people are going to give you a pass. They're not going to give you a pass on knowing your own contract. I'll turn it over to Shane for other ideas.
God, I should have just changed my name to Shane.
Don, I keep seeing the Shane pop up in my screen. I meant Shawn, so I'm sorry.
I'm gonna take this a little bit different. Everything I agree. Just to add to that, I kind of also want to say, trust the process. And what I mean by that is, step one, data room, market materials. There's a process that's been proven many, many times, and a lot of people, it's that emotion. Is this going to get done? I'm scared. I'm worried. That trust the process that's going to happen. that this has been done many times. So trust that. Know your outcomes before you go into any of the transactions. You'll go, I'm happy with this range, with this exit, this outcome, I'm happy with it. Because maybe you get that offer at the end and you're like, I don't want this anymore, I want more. It's like, no. We've kind of set this range, we worked toward it. Remember your goal, what you wanted to do with this after. Have that, I'm gonna say, really plan things out in advance, what you want to do after, start those hobbies, whatever. Have that vision of the whole thing going through smoothly, the processes and the exit, be happy, and that there's a life after whatever this transaction is, and just calm, relax, breathe. I think that really helps with the success of it. And then, yeah, I think that the emotions, I don't know, I've just seen people just stop talking, deals go south. I've seen people just, there's so much emotion goes into these that I just wanted to add that. But
Sure.
That's part of our role, is to be part of that, though, and to help keep guiding, keep moving, keep things efficient, keep things moving forward.
I echo everything Shawn said. Almost
I need a nickname here or something like that. That guy.
Got it right. I'd echo that, but I think part of that too would be something else, right? Which is, and I'm thinking about a software transaction specifically, like as you're getting close to signing and closing a deal, unless there is a trying to get every single contract, right? Because it's sort of ARR based, and you close a contract, you've added $3,000 or $5,000 of additional ARR because you closed one contract, and it's just not meaningful. Trying to withhold negotiations or trying to wait, as certain contracts drip in, you're really taking your eye off what's the end goal here, right? And nothing really bothers investors where they're getting nickeled and dimed right after they've made a commitment, because a contract here, a contract there comes in, right? I mean, at a certain point in time, you're on the same side of the table and you're trying to grow the business. Again, I'm thinking here on a capital raise. If it's a sale process, if you're 100% out, maybe okay, but more often than not, the processes that I'm involved in, there's some equity role. The owner is staying involved, whether to manage the business, to stay on as a senior advisor for 2 years, provide transition, and at a certain point in time, right, that sort of, as you get down there, if you're every single contract, if you're calling the investment bank, we just got another contract, we just got another contract, we got to redo everything, it breaks down, right?
Yeah. Make sure you're hitting your numbers and milestones though during this whole process. Don't take your eye off the ball. Yeah.
Great. So next thing I have here is, and this kind of on the flip side of everything, I guess, but who is not such a good fit for an investment banker? And Shawn, Shane, do you want to take that one?
Sure. Someone that's not coachable. Right off the bat, I would say that egos, a lot of people, everyone's got an ego, I guess, but some people that won't listen to outside guidance, outside advice, might not be a good fit. Size is huge. If you're, depending on what you want to do, if you want to sell your company, if you're $1 million in revenue, investment banker is not the right fit. You might want to talk to a business broker. You might want to talk to an M&A advisor to help you out. There's definitely a size component to the transaction that makes it feasible for an investment banker to be a part of it or not. There's quite a few, and then once you're in the realm of investment banker, which investment banker do you choose? Do you choose the boutique one or the big name? There's a huge range of who you should work for, investment banker and not investment banker. And there's a lot of components that go into that decision.
Great. Evan, do you have anything you wanted to add?
Sure. Again, we work with companies of all sizes and all industries. And so we do spend some time, sort of like, where is the line, right, from investment bank to business broker? And then we get the question, like, what's the difference between an investment bank and a business broker, which I can answer, which again, longer discussion, but I would say, investment bank is proactive. A business broker is more of a listing, right? From creating an action plan to more of a reactive sort of listing. That's in some very broad sense, and trying to think about the differences between the two. In my experiences, it really comes down to size, and because of minimum fees. That said, there are a lot of, the world has gotten more democratic, if you will, right? I mean, technology is really enabling lots of boutique firms, and you're finding very, very qualified investment banks and individuals that will do smaller transactions that perhaps 10 years ago, that type of size range wasn't being done. Shawn mentioned it earlier, valuations these days are also, quite high, I think are very favorable, right, to companies, whether they're selling or whether they're raising capital. And, in the tech world, we talk about, the ARR multiple, and when those multiples are double digit, if you have a business with $1 million of ARR and the multiple is 10, that's a $10 million business. If it's a 15 multiple, let's say, and being valued on that ARR, it's 15. So it's really size. And I would say that, these days, the lower end has gotten more inclusive. If you wanted to talk about sort of changes in the landscape, I think it's more inclusive, and there's a lot of very high quality individuals and firms that'll do smaller transactions that are out there.
Great. We have time just for a couple more here, but what are the steps involved in an M&A process or raising a growth round?
Okay, I mean, the steps in both are pretty similar in the sense of creating the data room, which all everything you can think of for a company, more or less, you put in this one area where that information is used. That information is used to create the market materials, the confidential information memorandum, the executive summary, and then later for due diligence. Once that market material is ready and you have the potential list of either buyers or investors, you go out to market. From that, you get information, questions, we want to know more about this, set up management meetings. From that, it can go to, send out the process letter to get the indication of interest. Then from that, you sign one, go to, due diligence. It's step by step, but think of it actually, I should just, let me go back. What would be better is to think collecting the data, creating the market material, going out to the market, and then closing, wrapping it up. Those steps, with each of those going a lot more granular. I don't know the audience here, so I don't want to get people too confused, but just think of it as there's a few steps from, getting the information to finding who might be interested in it, to having conversations with them, to closing.
Great. Evan, you have anything you want to add?
No, I mean, I'll take it a little bit further than that, which is, I think Shawn talked about the stages, right? From, preparation, understanding the business, to creating marketing materials, to accessing the market, to receiving indications of interest and preliminary sort of, results of what the marketing process has resulted, to pushing that further to more, substantive bids, to a closing process and choosing and moving forward. What I was going to take it further to say is the time frame of that. Like, what does that look like from a timing perspective? And historically, and the history is, I'm not talking about 30 years ago, I'm even talking about 5 to 10 years ago, which is, I would generally advise people that a process is a 6-month type thing, sometimes shorter, sometimes longer, but 6 months was like a decent rule of thumb. These days it's being condensed a little bit, at least in my experience, which is in the last 2 years, especially with Zoom and other formats of virtual meeting. I mean, I can point to multiple examples, I'm sure Shawn can as well, in the past 2 years where people did a transaction, never physically met, right? Someone walked around a facility with an iPhone and people looked at the video. That obviously has changed, right? People are getting together, regardless of surge or not, or how things are happening today. General theme, I think, from transactions has been that have been condensed, which is people are no longer doing what's, I say no longer, it's a less of a quote unquote roadshow, meaning traveling around, visiting multiple cities, trying to meet with multiple buyers in different areas or multiple investors. The process has become much more efficient. Technology moves faster, virtual data rooms, people can disseminate information very fast. They can put deadlines out, they can reach lots of people very quickly, and they can do meetings quickly. Therefore, that 6-month process has really started to condense. And I'd say the average sort of process now, right, is, more on the 5-month mark. It just seems to be things are moving faster, right? From, when I say 5 months, from the date that you say, okay, let's go, we're going to hire somebody, we're going to make this happen, to the date that the funds are in the bank account. I think that time frame moved faster, but it still involves the process and all of the steps that Shawn laid out.
Yeah. And that time frame, a lot of it depends on, the company itself, how long it takes to get those documents together. I mean, there's some companies that will come that have everything already prepared, everything already, and you're just pretty much going. They might even have the sim or the market material created from a third party. And there's others where you have to have that conversation on day one. We need each of these documents for the data room. This goes in this folder, this goes in that, and that process that others have completed before they talk to you, you're spending 6 weeks working with them to build this out. And I mean, this goes to fees as well. If you want to really be efficient with it, how prepared you are, how quickly you're able to, that can change that process window quite a bit.
Great. Maybe to lead us out here, again, if anybody has any last minute questions, you can drop it in the chat now. We might be able to get to one or two more. But maybe carry us home for now with, what is the biggest misconception people have about investment bankers? Evan, you want to start us off there?
Sure. It'd be funny to hear what Shawn's views are first, without me speaking. But I'll take some of the easy answers to that one, which is investment bankers aren't miracle workers. They're not. It is a business where the buy side investors, buyers, generally are very sophisticated, right? And so the idea of, we can have an agent somehow, make a house look better than it is because we turn on all the lights and we open up all the closets for a showing. It just really doesn't apply. I think a lot of people think that there is some magic. What Shawn said it best, and there's a process, and the process allows buyers, investors to look and to draw out, those people that are really interested. And the idea that, bankers are miracle workers just doesn't fly. The idea that, that banks are, in it and then looking to be in and out. I would say, and Shawn had mentioned this earlier, right? Which is, and he made the eloquent point, which I really liked, which is, it's also about someone's significant other, right? When I'm on the phone and I'm working with a client, we could be talking on Saturday morning, we could be talking on Friday nights, we're talking, during the day, or the founder, we're selling a business and the founder doesn't want other people in the office to know, so he's taking long walks during the day, or, working at different odd hours and various things, and such that, it affects the people around, and, it becomes part of, the ethos of, of what that person's doing and how they're acting every day, because they have this, transaction that's sort of weighing on their mind. My point would be, investment banks aren't in it to be in and out. You build a real relationship, right? You're building a relationship, you're spending a lot of time together, and, hopefully, right, and especially if I'm involved, but hopefully regardless, right, it's a really good relationship. And it's not just for here, it builds on itself, whether it's for the next venture, another business, buying a business after you sell, or doing other things, because you spent such time together and you built a trusted relationship. So the idea of disposability, the idea of, turning around quick, I would reject that philosophy and say, the investment banks that you want to work with, and to make it all work really well, you want to invest in the relationship. The more you put in, the more you typically get out, as in most things in life. And I think, again, the idea that we can switch or move or change, it doesn't work. In 100, 150 plus, companies that I've advised over, the last years, we've only had 2 situations where we moved investment banks during a process or at some point in time. And it's very painful and very hard to do. People really invest in this, the banks invest a lot. And so again, I would just, re-emphasize the idea that, you want to get it right. You want to put a lot into the relationship. And if you do so, it should come back to you.
The part of miracle workers that says it, that sums it all up. I mean, you'll have conversations with people and they think, if you work in an investment bank, it's a done deal. No, they can't put, lipstick on a pig. Not miracle workers, not magicians. No, I love that. I think I'm going to use that from now on. But the only other thing I'd like to add to that is sometimes I'll hear, hey, all banks are the same. I would definitely echo that, all the investment banks, they have their niches, they have their strong points, their weak points, but I'd say, they are quite different. So that's one thing. Also, maybe it's just some of the conversations I've had, but thinking that banks charge a ton of money and they get paid way too much for the work they do, that they're just kind of sitting there idle. In reality, there's hundreds of hours that go into each of these deals, and they don't see the people, on the research team do it. Most people don't see the hours that go into it. So they don't really understand the fee structure. They don't really understand, how much money goes here, the compliance or the analysts or salaries or things like that. So I think that there's a misconception there, but more than anything, yeah, the miracle workers. That I think that's perfect.
Well, great. That's about all the time we have today. Thank you guys so much for joining. It was a great session. I hope the audience got a lot out of it. I will be sending out, just for everybody, the recording of the session. If you want to review anything, that'll be tomorrow, hopefully. And if you have any other questions, you can email me at shanepinak@10capital.group. But yeah, for now, that's all we have. And again, thank you guys so much for joining us. It was very insightful.
My pleasure.
Thank you, Shane. Thank you, Evan.
Yeah, likewise. Likewise.
Bye, guys.
Thanks.